Dear students, today we are discussing the topic capital structure. Capital structure, as the name indicates, it is the combination of debt and equity capital. Or in other words, it is the proportion between debt and equity capital. For example, if we are using only debt capital and debenture and equity, the proportion, the ratio between that debenture and equity is termed as capital structure. Capital structure is also called financing mix or capital mix. When we say the term capital structure, we have to go through another term, that is financial structure. It is the proportion between short-term debt, long-term debt and equity. As compared to capital structure, the difference is that financial structure consider this short-term debt. And capitalization, we have already mentioned, it is the process of determining total amount of capital required by a firm. Here is an example. Calculate capitalization, capital structure and financial structure. Okay, here when we calculate capitalization, the amount of capitalization can be 11 lakhs or 12 lakhs. For example, capitalization is the process of determining total capital, that is equity, preference, debenture, long-term loans. Some others take retained earnings also. If we take it or does not take it, no problem. Here in this example I have not taken 5, 8, then 10, 11. It is capitalization. If you write it as 12 lakhs, that is including retained earnings, there is no problems. Capitalization can be 11 lakhs or 12 lakhs. Here in this example we are not taking that. The second area is capital structure. Capital structure is the proportion between debt and equity capital, different sources. Here when we calculate capital structure, these are the three columns to be provided: source column, amount column and also one percentage column. The percentage column total should be 100 or 1. Okay, here equity capital I have calculated is by considering only 11 lakhs. If you take 12 lakhs and take retained earnings, here also there is no problems, because I have given both the examples here. In one example retained earnings is included and in the second example retained earnings is included. Okay, here it does not include. In first case no retained earnings, in second case there is retained earnings. Whatever may be the case, you have to provide the columns: source column, amount column and percentage column, and find the percentage of each item of the capital. Okay, then and third also you asked to calculate financial structure. It is calculated in the same manner. Provide three columns: source, amount and percentage. The difference between capital structure and financial structure, we have already mentioned that it includes current liabilities. Okay, including current liabilities we will find the financial structure. So the total amount will be 14 lakhs and total should be 100. Based on these 14 lakhs we will find the percentage of all these items. Okay, this is how we will calculate capital structure, capitalization and financial structure. The next topic is patterns or forms of capital structure. Capital structure can be created in the following formats, that is include only debt capital, equity capital, then equity and preference capital, equity and debt or debentures, equity, preference and debentures or debt, whatever it may be. Okay, these are the forms of or patterns of capital structure. Then next term is optimum capital structure. Optimum capital structure is the combination of debt and equity capital with the maximum value of the firm and minimum cost of capital. The main peculiarities of optimum capital structure is maximum value and minimum cost. It is planned by considering solvency, marketability and control. Then while we discuss optimum capital structure, we have to consider two risks. There are two risks to be considered at the time of creating capital structure, and the two risks are: first one, financial risk. we have already mentioned what is financial risk at the time of discussing financial leverage. Okay, it is the risk due to debt, use of debt or fixed income securities. It may arise due to the inefficiency to meet the fixed interest or dividend commitments. If you are not able to make payment of interest on debt, that is called a financial risk. And the second risk is non-employment of debt capital risk. It is termed as NEDC risk. Non-employment of debt capital risk is just opposite to financial risk. That is, it is the risk due to not using debt capital. If you are not using debt capital, the benefit of financial leverage or trading on equity will not be available for us. Okay, so we have to find a trade-off between these two, because if we use more debt capital, there will be increased financial risk. If we are not using debt capital, there is NEDC risk. So the trade-off between these two risks are to be identified, which will provide minimum risk and maximum value. That is called optimum capital structure. Okay, here I have drawn a diagram showing a graph showing the optimum capital structure. Okay, this is financial risk. It is moving upwards, financial risk, because when the leverage increases, when debt capital increases, the financial risk will increase. Okay, when the debt increases, the NEDC risk, because we are not using debt. Okay, when in this case NEDC risk will reduce. Okay, when we use more and more debt capital, any non-employment of debt capital risk will be lesser. Okay, here is an intersection point between these two lines. That line, this area, this dotted area is termed as optimum capital structure. In this case, the total risk will be minimum here. The risk line goes just like this. So in this case, there is minimum risk, and this area is called optimum capital structure. Okay, this is how we will represent this optimum capital structure by considering financial risk and NEDC risk. Next term we would like to discuss is capital gearing. It is the proportion of debt in the total capitalization. It shows the ratio between equity and debt. There are two situations, that is inflationary condition and deflationary condition, that is boom period and depression period. In boom period, an ideal gearing ratio is suggested that there should be high gearing. That is, in boom period, there are a lot of business opportunities, there will be high return for businessmen, there will be increase in price, etc. So during inflation period, it is better to be high geared. That means more debt capital can be suggested. But whereas in depression period, low gearing is suggested. In depression period, it will not be beneficial to use more debt capital because the firm will not be able to repay the returns required. Okay, thank you very much.